Have you ever wondered why most investors blow their account while only a few consistently make money, despite having access to the very same market? After working with over 1,000 investors and getting a deep insight into their mistakes, I discovered the traits that make investors lose money. Learning this determines whether you'll grow your wealth consistently over time or stay stuck in the endless cycle of chasing stock tips, getting burnt, and feeling like the market is, well, ultimately rigged against you. So here are the 5 crucial lessons that I've learned. Lesson number 1. Let's start with the obvious. They don't have a proven strategy. Most investors enter the market with no methodology whatsoever. They buy stocks based on their feelings, media hype, or what their friends tell them. And because you're left alone to be your own voice of reason, well, you're going to do whatever you want to do. And sure, sometimes people get lucky, and some even get very lucky, winning massive on one single trade, and then build a whole marketing campaign around it, selling you the same luck. But relying on luck isn't a strategy. Without a structured, repeatable system, any gains you make relying on luck will absolutely get wiped out by bad trades. You need a tried and tested blueprint, one that aligns with the long-term trends and patterns of the stock market, that navigate you through all market conditions, especially during turbulent times, that minimizes losses and protects capital, but that positions you to handsomely profit when the next boom phase kicks in. Lesson number 2, they let emotions control their decisions. The market is a psychological battlefield, but it all starts with having a proven process first. But if fear and greed drive your investment decisions, as it does for most, we always really hear about how many people fail or underperform, then it confirms that emotions are a guaranteed way to lose money. People's MO often starts with fear when they see a market is booming, thinking a reversal is imminent. Eventually, hope and greed creep in when the market is at all-time highs, throwing their life savings into stocks just because the media says this is the hottest stock in the market right now. And then when the market reverses sharply, fear takes over and they panic and they sell everything at a loss. Later, when the market recovers, fear keeps them from getting back in and they miss the entire move. This cycle repeats over and over and over again. It's just all emotionally driven. The best investors do the absolute opposite. When everyone else is euphoric, they stay cautious. When others are scared, they see opportunity. Be patient, but with a plan when others are greedy, flooding the market with money, and then be decisively hungry and clean up when others are fearful. Okay, lesson number 3. They listen to the wrong people. If you've ever taken a stock tip from your neighbor or your Uber driver or a random influencer on social media, then ultimately you're not alone. The problem, none of these people have a track record of consistently making money in the market. They do, however, have a track record of spreading misinformation. If you have a strategy, you won't need to rely on advice from people with no expertise. You'll have a system that tells you exactly when to buy, when to sell, and when to do absolutely nothing. A key rule of sound investing is to ignore opinions, including your own. The truth is in the charts and on the higher timeframes where the big moves are made. So ignore the noise, follow your strategy. That's how real investors win. Lesson number 4, they lack patience. New investors always want to jump in immediately. They're eager to put on their first trade and start making money. But investing isn't about speed, it's about precision. Buying a stock prematurely leads to mistakes, and mistakes lead to losses. A great example of patience paying off in my portfolio was during 2015 and 2016. At the time, the S&P 500 was stuck in a consolidation phase, moving sideways between support at $1,800 and resistance at $2,100. Only a very few stocks were performing well, so we were very selective with the stocks we bought and how much risk we allocated to each of these stocks. Now, while we stayed profitable, the real gains came after the S&P 500 broke above $2,100 in July 2016. Once the breakout happened, we became more aggressive at taking positions in line with the rising index. The S&P went on to climb 34% over the next 18 months, more than making it up for the slower period, and our portfolio grew exponentially during that boom period. We used our stock market blueprint to navigate profitably through this period and continue to use it today. If you want similar results, we've included a link below this video for you to download the blueprint. So the lesson here is that you don't need to trade every day. You don't need to jump into every stock that looks interesting. You only need a handful of strong performing stocks each year to make very good returns. Sometimes I'll even enter a stock later than everyone else, ensuring my criteria for entry is met. And while others chase short-term gains, I'll compound my returns by buying more as the stock climbs higher. The market rewards patience. The best investors wait for the right setups instead of forcing trades. Okay, lesson number 5, they simply risk way too much. One of the biggest reasons investors blow up their accounts is over-risking. You should never risk more than 2% of your total portfolio on any single position. In highly volatile markets, even 1% or 0.5% risk per position is actually smarter. Now, here's why. A 20% loss requires a 25% gain to break even. A 50% loss requires a 100% gain just to get back to where you started. Yet most investors only focus on potential profits, ignoring how close they are to wiping out their entire portfolio. If you focus on risk first and protect your capital, profits will take care of themselves. Cut losers quickly, let winners run. That's how you build long-term success. Okay, that takes us nicely onto lesson number 6. They don't take accountability. When investors lose money, they blame the market, the news, the economy, everyone and everything except themselves. If you take accountability, then you'll look at every loss as a learning opportunity. Successful investors take responsibility for their mistakes. They analyze where they went wrong, adjust their strategy, and improve over time. And you eventually get to a point where you simply do not make mistakes. You follow your plan with absolute precision, perfected the all-important investor mindset, and think solely in terms of profit and loss. The ones who refuse to take accountability stay stuck in a cycle of losses. Remember, the journey within is the one least traveled, but it is where the answers lie. I recommend buying a one-way ticket and see how far the journey takes you. You will surprise yourself and you may actually end up enjoying it. I'll be intrigued to know how you get on. So here's what you can do differently. If you recognize any of these mistakes in yourself, then hey, it's all good. Don't worry, you're not alone. It's just a case of putting into practice what actually works. Most investors go through these struggles, but it is the ones that accept that what they're doing isn't working and then replace it with methods that do work that become successful. That is a fundamental difference between me, Zahir, who could not invest, to Zahir today, who can actually invest and is a very accomplished investor. The good news, you do not have to stay stuck. Just let go of what doesn't work. The great news is that by watching this, you have now entered the Sublime Trading ecosystem, where we share a proven system that removes emotions from your decisions, helps you stay patient, and minimizes risk, and puts you in that much sought after position of seeing consistent growth over time. Okay, understanding why investors struggle to make money is only useful if it's paired with a clear plan to achieve consistent profits. The key is having a solid, proven weekly process. In this video, we share our process, which helps us earn an average of over 30% annually in the stock market.